So this is everything you need to know about stable coins, especially looking at how the Iron Titan stablecoin or supposed stablecoin crashed from like 60 something dollars to being worth zero. But let's first look at what are stablecoins. And this is why some want regulation of what stablecoins, because I actually do see there was a billionaire, I think Mark Cuban, that invested a lot into this Iron Titan coin that was meant to be stable, and it crashed. So I can see why some want regulation on what is deemed as a stable coin. Because there's stable coins are basically when you try to have it linked to something that is more stable, such as the currency, fiat currencies. So here we can see many stablecoins are pegged at a 1-to-1 ratio of certain fiat currencies, such as the US dollar or the euro, which can be traded on exchanges. Other stablecoins can be pegged to other kind of assets, such as precious metals like gold, or even to other cryptocurrencies. So why use stablecoins? Stablecoins are not subject to extreme price volatility that other cryptocurrencies are affected by. So this is the point, because in 2010, for example, a programmer purchased pizza for 10,000 bitcoins, which was $30 at that time, 2010. But in 2018, that same order would cost 82 million. So it's about how volatile it is. So let's see, stablecoins also present major advantages across the financial services ecosystem as a whole by enabling decentralized system that is secure and stable. Everything from cross-border lending to financial planning could benefit. With decentralized lending, for example, stablecoins could help ensure a reliable environment for peer-to-peer, P2P transactions to take place without needing to use a volatile cryptocurrency like Bitcoin to transact. But let's have a look. So what are the types of stablecoins? So fiat collateralized. So we talked about those ones that are backed by fiat currency like USD, EUR, British pounds. Fiat-backed stablecoins are backed 1-to-1 ratio, meaning one stablecoin is equal to 1 unit of currency like a dollar. So for each stablecoin that exists, there's theoretically real fiat currency being held. And this is actually, someone's asked me, but what is cryptocurrency in general? What is it backed by? So people think money is backed by gold, and that's how things used to be. But then they start making IOUs and paper money and issuing out more IOUs and more paper money than has actual gold reserves in the account. So even money is not really backed by gold either. But people believe it's more safer because it's meant to be backed by gold. There should be your actual money in the account. But the amount of money in the world, in the numbers in the bank, the numbers on our screens and stuff that we're seeing, there's not actually that real amount of cash in the bank. So that is a myth. People think that money is actually backed by something in a sense. So the same with stable coins. Technically, it's backed by every 1-to-1. So 1 USDT should have a reserve there. But later on, we'll see that even USDT was having problems. Like here, the most popular stablecoin is Tether USDT, which is currently the third largest cryptocurrency by market capitalization and has the highest daily trading volumes of any cryptocurrency, including Bitcoin. Tether represents the majority of global stablecoin supply and set a new record in January 2021 by issuing 2B tokens in just 1 week, 2 billion tokens in just 1 week. However, the cryptocurrency has been surrounded by plenty of controversy. Suspicions have arisen that Tether has issued more USDT than it is actually backed by its USD reserves. US Department of Justice has investigated Tether and crypto exchange Bitfinex, which share management teams, for potential market manipulation. In 2019, the New York Attorney General also launched an inquiry into the apparent misuse of Tether cash reserves. For this reason, many new fiat collateralized stablecoins have risen up in an attempt to take Tether's place, but Tether's still standing strong. But they do have to show their records. They do have to show the reserves and what they are being, how they're backing, what's their pegging looking like. So other ones, so commodity collateral stablecoins, the second type of stablecoins. Commodity collateral stablecoins are backed by other kind of interchangeable assets such as precious metals. The most common commodity to be collateralized is gold. However, there are also stablecoins backed by oil, real estate, and various precious metals. Holders of community backed stablecoins essentially hold a tangible asset that has real value. So one type is DigiGold. DGX, for example, is an ERC 20 token built on Ethereum network, backed by physical gold, where 1 DGB represents 1 gram of gold. This gold is stored in a vault in Singapore and gets audited every 3 months. And then you got TCX is backed by not one commodity, but by a combination of 7 precious metals commonly used in technology hardware. The idea is that as these metals are increasingly used to make technology such as solar panels and electric cars, TCX coins will go up in value. Swiss Real Coin CRS, another example, which is backed by portfolio of Swiss real estate. Token holders can even democratically vote on the investment choices. Then you got the third type, crypto collateralized stablecoins. These are stablecoins backed by other cryptocurrencies. This allows crypto-backed stablecoins to be much more decentralized than their fiat-backed counterparts, since everything is conducted on the blockchain. To reduce price volatility risk, these stablecoins are often over-collateralized so they can absorb price fluctuations in the collateral. For example, to get $500 worth of stablecoins, you would need to deposit $1,000 worth of ETH. In this scenario, the stablecoins are now 200% collateralized and can withstand the price drop, let's say of 25%. This would still mean that $500 worth of stablecoins are collateralized by $750 worth of ETH. So, crypto-backed stablecoins are the most complex form of stablecoins, which means they have not gained as much traction yet as they continue to work out their kinks. The most popular and promising example of a crypto-collateralized stablecoin is DAI, created by Mark Cuban. DAI is a stablecoin that has face value pegged to the USD, but is actually backed by ETH that is locked up in smart contracts. So, and then you got the fourth type, non-collateralized stablecoins. Non-collateralized stablecoins are not backed by anything, which might seem contradictory given what stablecoins are. The US dollar used to be backed by gold, but that ended decades ago, and dollars are still perfectly stable because people believe in their value. The same idea can apply to non-collateralized stablecoins. These types of coins use an algorithmically governed approach to control the stablecoin supply. This is a model known as seigniorage shares. As demand increases, new stablecoins are created to reduce the price back to the normal level. If the coin is trading too low, then coins in the market are bought up to reduce the circulating supply. In theory, prices of these stable coins would remain stable as they are driven by market supply and demand. This is the most decentralized and independent form of stablecoins as it isn't collateralized to any other asset. However, non-collateralized stablecoins require continual growth to be successful. In the event of a crash, there's no collateral to liquidate the coin back into, and everyone's money would be lost. So, real world applications. Stablecoins have many potential real world uses here. For example, day-to-day currency, streamlining recurring P2P payments, fast and affordable remittances for migrant workers, protection from local currency crashes and market volatility, improved cryptocurrency exchanges, but their limitations. While stablecoins present many advantages, they also have their limitations. Tether provides an example of how a stablecoin can go wrong. Fiat-backed stablecoins are centralized, meaning they are run by a single entity. This requires trust that this entity is actually backing up their stablecoins with real fiat. To solve this trust problem, stablecoins should provide regular audits from third parties to ensure transparency. This will help ensure that they are trustworthy and can keep their reputation high. Fiat-backed stablecoins are also constrained by all the regulations that come with the fiat currency, compromising the efficiency of the conversion process and the potential efficiency of the digital asset. For example, Facebook's Libra currency promised a stablecoin backed by a basket of global fiat currency, thus broadening the coin's appeal and utility. However, it has received so much regulatory blowback that the project management has since dropped its multi-currency aim, distanced itself from Facebook, and rebranded altogether. By nature of being more regulated, stablecoins may also have less liquidity than regular cryptocurrencies. This is especially true for commodity-backed stablecoins. If you ever wanted to get your real bars of gold, for example, it could take months and an expensive trip to the vault. Moreover, there's always the risk that the underlying asset crashes in value. So, but now on to how this is everyone's worst nightmare. So every investor's worst nightmare is seeing one of their investment holdings price drop to zero. And this is what happened like 3-4 days ago with IM Finance's titanium token cryptocurrency. Now, this was meant to be a stablecoin, but in just one day, Titan fell from its all-time high price of $64 on Wednesday to practically zero on Thursday, the 17th of June. This was almost 100% decrease in value of the Titan token. This collapse is even starker when you consider that the total value locked into the Iron Finance decentralized finance protocol was about 2.18 billion. And at the time of writing, the total value crashed to just 29 million. Titan is currently trading at this 0.000033625 at the time of writing. So, but what happened? So, the background of Iron Finance Protocol tokenomics that explains the condition that led to this crash. The perfect storm for the Iron Finance Protocol flawed tokenomics, panic selling by whales and other individual investors had a host of other factors led to Titan's token price crashing. What you can learn from this, though, so what we learn from is do not follow billionaires or anyone for that matter blindly, and do your own due diligence before investing any of your money. Also, it's important to diversify your portfolios. I talk about that in my previous videos, looking at balancing your diversifying your portfolio. Then we also can learn DeFi projects and cryptocurrencies are still very risky investments, as the whole space is still in its infancy and kinks are being ironed out. DeFi projects and cryptocurrencies are still largely unregulated. Also, due to its decentralized nature, there will be little to no consumer protection when stuff like this happens. And many people actually believe that just like banks offer you 85,000 compensation because they're regulated by Financial Conduct Authority and the FCCS compensation scheme, some people think even cryptocurrencies bound by these regulations, but they're not. Some people do things blindly. But what happened to Iron Finance and Titan token? Because this protocol is a multi-chain partial collateralized algorithmic stablecoin. The protocol's main product, so to speak, is its Iron token, a stablecoin that is soft pegged, is the key here, to the US dollar, which is available on both the Polygon and Binance Smart Chain. But how Iron Finance main goal is to ensure that the Iron's token's price is stable and maintains its peg to the US dollar. If the system works as designed, you will be able to redeem one Iron token for about $1 worth of tokens. To achieve this peg, Iron Finance has stored collateral into time-locked smart contracts on the blockchain networks, where the collateral is automatically mined or redeemed and managed algorithmically. For Polygon's network, Iron is backed by a combination of stablecoin like USD Coin and a volatile asset like the Titan token. For the Binance Smart Chain, Iron is backed by a stablecoin like Binance USD and a volatile Steel token. Basically, the tokens are managed by minting and redeeming systems, which works in the manner. So they're trying to do supply and demand, just like we heard what we've read here about non-collateralized stable coins, a mix between this and a mix between crypto collateralized stablecoins. So they're a mix in a sense. So also the ratio mine redeem of USDC and BSC Titan tokens is based on the target collateral ratio and by the effective collateral ratio set by Iron Finance. This collateralization ratio for Iron, USDC and Titan is a floating number that is managed algorithmically to maintain the float. So they're all trying to just balance the supply and demand. All in all, this means that there's no direct correlation between the value of Titan and the circulating supply of Iron. When new Iron tokens are minted, there will be a corresponding increase in demand for Titan tokens, which will drive up the price. On the other hand, when price of Titan falls drastically, like what happened on Wednesday, the peg becomes less stable. So how did it collapse? Here's a breakdown of what happened according to post-mortem blog post from Iron Finance at about 6 p.m. Singapore time on Wednesday. There appeared to be some whales who were messing about with liquidity on Iron Finance protocol, causing the price of Iron to go off peg. In this cryptocurrency world, a whale refers to individual groups or companies that possess large amounts of specific crypto token. This caused the Titan token's price to crash from $65 to $30 in 3 hours, but Titan's price managed to bounce back in 1 hour to $52 and Iron's peg was restored. But later that day, around 11 p.m. SGT, more whales started selling again. This triggered panic as many users started redeeming their Iron tokens to sell their Titan tokens. This created a negative feedback loop, because when more users redeem their Iron, more Titan is created, which floods the supply of tightening the market and drives the price down, because if there's lots of supply but not enough demand, then prices will go down. The panic selling from holders of the Titan tokens did not help either. As such, the market was flooded with huge supply of Titan tokens, which may have caused a bank run. So a bank run happens when the majority of the customers of banks or other financial institutions, in this case the Iron Finance Protocol, try and withdraw their money all at the same time. Because remember, they don't actually have all of that available. Just like if people all went to their bank right now to do a bank run, this will happen. The same thing, a crash will happen because they don't actually have all that money in the bank for you. So this selling pressure also activated the Iron Tokens mechanism that mints more Titan tokens and removes liquidity in an effort to restore the Iron Tokens pegged to $1. This created a big arbitrage opportunity due to the price difference between Titan and Iron, as explained by Iron Finance. Many people capitalized on the arbitrage opportunity, which resulted in more Titan tokens being minted, which flooded the market and added more selling pressure. This in turn destabilized the Iron's token price further, and it was a cycle. And one of the most high-profile victims of this bank run was Mark Cuban. Victims of this bank run, or rug pull, as many in the world of cryptocurrency would call it, it is American billionaire Mark Cuban, entrepreneur, television personality, Shark Tank, and investor who has a net worth of about $4.4 billion, is involved with. And he wants more regulation because of all of this. And we see his blog posts enable QuickSwap to offer swaps between these two tokens. As you can see here, this pair is one of many, and you can see that based on the 2.5 PCT of the volume in this swap, that QuickSwap pays. My return on my investment, 75,000 investment based on fees only. As of this writing, is an annualized return of about 206% based on the fees earned last. In an interview, CoinDesk, Cuban refused to reveal how much he had lost, stating that it was enough that he was not happy about it. So, few points: do not follow billionaires or anyone that matter blindly, and do your own due diligence. So that is everything you need to know on stable coins, and we can see why some are calling for regulation. Because if we go back to the safest types of stable coins, will be technically USDT, the ones that are backed by fiat, and the ones that are being backed by commodities, so more hard pegged stable coins than these soft ones where they've got part of it is mixed with a volatile cryptocurrency. So make sure to subscribe, share, and let's look at what's going on with Bitcoin. So you can see I'm happy that I changed some of my things. I took out my profit and I'm just waiting, because one of the buy the dip strategies to just wait to see the dips over. So I did change my things into a USDT. And we're waiting to see what's going on, because it's still been on a downtrend for nearly 2 months now.